Hello, welcome to Smart Investment Journeys. This podcast is part of a series designed to help you along your investment journeys. Welcome to this week's episode of Smart Investment Journeys. I'm Rod Hurd, your host, and today we have Art Johnson, the CIO and co-founder of SmartBe Wealth Inc., here to talk to us about trend following, investing in low interest rate environments, and how to manage your equity portfolio when dividend and preferred share pricing is priced to perfection.
Thanks, Rod. Let's talk about trend following because I think it's really important. And it's important in the sense that we're in an environment that's very difficult because of low interest rates. We want to take you on this journey and demystify words like trend following. What the heck does that mean to most people? Let's take that apart and really understand what it is and what it isn't and why it's good for you. So let's start with trend following. And there's a little bit of noise around this term. And what I mean by that is, for a long time, it was in question whether it was really something that was statistically significant, which means that academics actually could see the data and understand the data, and it wasn't just Ouija stuff, and that it really was scientific in a way. That debate has been figured out in the last 4 to 5 years. We now see that there's tremendous statistical significance, which means that think of statistical significance as a way that you can believe it's valid. This is when I say, hey, I believe this or I believe that. You really want to know that there's some science behind what the tool we're using. Trend following has that now. So let's go into what trend following isn't before we talk about what it is. Trend following is not market timing. And this is where the debate around trend following was really hammered out in the academic circle. What market timing is that I basically decide, or a group of us decide, what we think is going to happen in the future. And I would tell you from my own experience, I think human beings are very bad at prediction. I really am bad at prediction. So I know only myself. I have stayed out of the prediction game. So predicting where markets are going to do and how they're going to do things and that, we think that's not the right strategy for most people. It sounds very sexy. And if you have 1,000 people predicting, every once in a while, 5 of them will be right. And they'll come on TV and tell you, look, I figured that out. I'm so smart. The problem is when we run them again on those same type of people, it's another 5 people that are predicting the thing. So it's kind of confusing for you as an investor, and we get that. But market timing is something that I think you should leave to other fields. Don't do it in your investment portfolios. What we would rather do is something called a rules-based strategy. So think of a rules-based strategy that does this. It's going to sound like market timing. Imagine a system that has statistical significance to take you out of the market and protect your downside. My God, that sounds like market timing. But trend following is not market timing. It is not using prediction in the same way that a market timer would. It is not an arbitrary process where I pick up the 8 ball from my desk and say, it looks like the market's going to do this today. What it is basically saying is there seems to be a way for a very low cost that we can actually protect your downside in a meaningful way. It does come at the expense of some of your upside. That has always been the risk of market timing. It seemed that people were not bad getting out of the market, but it was almost impossible to get back in. So trend following has 2 mechanisms. One mechanism is to get you out of the market, and the other mechanism is to get you back in. This is very important. These rules are known beforehand. So think of it. Corey Hofstein, who's a great friend of ours, has done some amazing work on trend following, and I think he uses the best analogy that I've heard. He refers to it as a stop sign. Think of a situation where you're a drag racer and you're driving all over town and your job's to kind of beat the light or try to beat it or do various things like that. That is not what we're trying to do. If I was going to use an analogy of a stop sign, think of us as like a nice retired person, very friendly, happy, rolling up to a stop sign and really, really willing to follow the rules. We're not drag racers trying to beat the market. We really want to be that person that says, it looks like if I'm in retirement or if I'm trying to build an investment portfolio, and the whole world is running over a cliff, I would like to not do that. I would like a system where it buys insurance for me to protect me from that. The downside is you got to be willing to give up some of the upside. I think that's a good trade-off for most people. Now, normally, for a lot of people, trend following seems like a great idea. Why is it so important right now? Well, I can tell you, we've worked with two of the best groups in trend following, Corey Hofstein out of Think Newfound, and then Wes and Jack at Alpha Architect. These are people, friends of ours, academics who have pounded over the data on trend following for years. Trend following is something probably new to most Canadians. They haven't heard a lot about it. So I think it's an important thing that we discuss its importance. Why it's super important in this time period. We're in a time period now where there's something called the TIPS, and that's the Treasury bond, Treasury inflation protected security in the States. What it does is basically say, hey, based on everything we know right now, what do we think interest rates are going to be for a very long time? It is paying 0.86% now. That's less than 1%. Think of that. If you are in 100% fixed income for the next 10 years, the TIPS is kind of saying you're going to get about 1% in return out of that. This has been one of the most historically low periods of interest rates. So if you are trying to use fixed income, which you should be in your portfolio to fund your retirement, typically you got 5, 6, 7%. We're getting less than 1% now. How this typically works as a portfolio manager, I would look at you in retirement and I'd say, okay, well, I need equities. What do equities do? They provide me profits against inflation so I can pay future obligations that you're going to have. Bonds provide me money that I can pay right now for your future obligations. They're not going to go down in value. The problem is, in retirement, you would probably do 60% fixed income, 40% equity, or maybe 70-30. We're in an environment where interest rates are so low, I have no idea how people are going to fund their retirement based on these low rates. So we have to come up with better and different tools. And I think trend following is exactly the tool that helps you in this environment. What trend following does is buy insurance only when you need it. Think of a fixed income product or a bond as insurance. It is there to protect you when the markets go down. The question is it worth having insurance when it only pays 1%? It's a tough question. One argument is, well, that's the way that's what the interest rate is going to be, so don't try to market time and figure this out, just accept it. I think trend following might be a better solution. What trend following does is allow you to own more equities, and then when equities turn down in value, the insurance kicks in. So you're only owning the insurance when you need it. This is a really important tool for retirees. If you have to take on more risk in equities, this is a good tool. Now let's think about what you're up against as any investor. In 1981, I graduated and I got a job on the trading floor. I was in love with a car I wanted to buy. It was called the Dodge Fire Arrow. I took all of my money and went down to the bank and I got a loan for 22% to buy that car. That sounds impossible to probably any millennial or anyone who isn't 55 years or older. But that's what I wanted to do, and that seemed reasonable to me, a 22% loan on a car. At the time, I was working on a trading desk, and we were selling 19.5% Canada savings bonds. I'm going to pause, let you think about that for a second. A 19.5% Canada savings bond. Wow, could I ever use one of those right now? Think about it though. At the end of the day, what fascinated me is people weren't buying those. Strips were paying 22, 23, 24%. Volcker was trying to stop inflation. He had jammed interest rates up because inflation was out of control. One of the tools to stop inflation was to jam interest rates up. So Paul Volcker, head of the American Fed, that's what he did. On a relative basis as people, we kind of take whatever context we're in and we think that's going to be the forever truth. People were saying, well, I don't need to buy a 19.5% Canada savings bond because I'm going to get probably 27 next year. Why would I buy that? I'm going to look dumb. To people in our context now, where interest rates have fallen from there to zero, they would love a 19.5% interest rate. What I'm going to ask you to do is think of how your context has shaped your thinking. I really don't think that people have gotten their head around how low interest rates are, just like people didn't get their head around how high interest rates are. So if you're entering a world maybe for 5, 7, 8, 10, 15 years where interest rates are 1, 2%, can you really fund your retirement? What you'll be hearing a lot from advisors is, you're either going to have to spend less or save more. And those aren't really palatable conversations for most people. What we really do is kind of hear that conversation and then deny it. So we're like, no, you're smart, magical man, you're going to pull it off somehow. Well, the reality is advisors have been trying to do that for a long while. They have been buying preferred shares. They have been buying anything with a dividend. We call this the desire for Y. And Y by I mean yield. Anything with a Y in the number in the stock market or in the name has been bought almost to perfection. So what that means for you as an investor is when stocks are expensive, you should probably expect low future returns. Just like on housing, just like on anything else. If anything is expensive, it's expensive for a reason, but it doesn't mean trees grow to the sky and you're going to get tons of more money. Stocks that are preferreds or anything in the Y column have been bought to perfection, we call it, which means that they have historically high prices right now. And it makes sense. What are we facing? I'm 55 years old. I'm the end of the baby boomers. There is the biggest generation of retirees coming into the stock market looking for yield, looking for safety. They're looking for things to fund their retirement. It would only be natural that there are only a limited amount of supply of those, and those people have already bought most of them up. So your advisors have been trying to solve this problem for you. The issue is going forward, those look really risky. You've got a very high priced Y type of stock that may or may not be able to fund its dividends. So it's a very difficult problem for advisors and for you as retirees. The other thing you should think about is prior to 1981, stocks have historically paid about 4 to 5% over inflation. This is about what you should expect for taking risk in the stock market. From 1981 down, stocks paid actually 9% over inflation. And that's because interest rates, inflation, and labor are some of the biggest attackers of profits for stocks. We're in a generation where the cost of actually hiring someone, labor was expensive because of inflation, and your interest rates on any of the projects you were going to do was very expensive. So that hurts your corporate profits. Those have had a tailwind from interest rates going down, the best they've ever seen. So it's a very important time to think about what you're going to do in your fixed income allocation, how to make it safe. And then I believe for our shareholders and our investors and the people that are involved in our fund, trend following is a phenomenally great way to solve this problem. We're hoping today that trend following gave you some insight in a way that you can solve a lot of the problems that we're all wrestling with. This isn't a SmartBe problem. This isn't a bank problem. It's something that we're all struggling with in the advisory world. A lot of the time, it's very tough to communicate to clients how tough it really is. So we're facing low expected stock returns and we're facing very low expected fixed income rates. Those are tough things to say to people. We believe that trend following is a wonderful tool to help mitigate the risk of those. And I want you to really think about it. It's not market timing. There's a lot of academic evidence behind it, and it's a really helpful low-cost tool to mitigate the downside and hopefully help in these low interest rate environments.
Thanks very much, Art. You really helped take some complex topics and make them really simple. And thank you, our audience, for tuning in to this week's episode of Smart Investment Journeys. We hope you join us next time when we'll have another exciting guest topic in the area of quantitative investing. If you'd like to know more about our smart tools and solutions or our smart beta approach, Visit us at www.smartbewealth.com or send us an email, info@smartbewealth.com. Let our transparent and purpose-built ETFs open the door for your clients to world-class strategies that are robust, rational, and repeatable.